In today's video, we're going to be going through tax planning strategies for managing multiple short-term rental properties because, believe it or not, it can get quite tricky. Hi, my name is Thomas Castelli. I'm a CPA and tax strategist who's helped hundreds of short-term rental investors reduce their taxes by up to 5 to 6 figures by using the short-term rental loophole. If you do like this video, make sure to hit that like button as well as the subscribe button and bell icon so you don't miss out on future tax savings videos. So why is it so challenging to manage multiple short-term rentals from a tax perspective? Well, let's just start with a brief recap of the short-term rental loophole for anybody who may be unfamiliar. All right, so what the short-term rental loophole allows you to do is allows you to take the losses, which are typically non-cash losses produced by the non-cash expense called depreciation, against your W-2, active business income, and other forms of non-passive income, which generally results in significant tax savings. Now, the challenge here is that you can have multiple properties that have an average stay of 7 days or less. However, to actually take the losses from your rental activities against these other forms of income and get substantial tax savings, you need to materially participate in each of your short-term rental activities. Now, in order to materially participate, you need to meet one of 7 tests, and 3 of them are most applicable to short-term rental investors. And they include, the first one is spending more than 500 hours in the day-to-day operations of your short-term rental activities. The second one is doing substantially all of the work on your short-term rental activities with little to no outside help. And the third one, which is by far the most popular one, is spending more than 100 hours on your short-term rental activities and making sure that no one other individual spends more time than you. And the reason why this one's so popular is because this allows you to materially participate in your short-term rentals while still delegating some of the tasks to cleaners and handymen for repairs and things like that, which is particularly important when you're managing properties from a distance. Now, the challenge here is that if you have 2, 3, 4, 5 rental properties, short-term rentals that is, that meeting one of these material participation tests can be quite, on each property can be quite challenging. Because even if you're using the 100-hour test, you're looking at spending 200, 300, 400 hours per year on your short-term rentals in total, which again, if you have a full-time job or you're running a full-time business, can be quite challenging to do. So that's where grouping your short-term rentals for the purposes of material participation comes into play. Now, when you're grouping your short-term rentals together as one activity, you only have to meet one material participation test across all of your properties, which eases the burden and the time commitment it takes to qualify for the short-term rental loophole across multiple short-term rentals. Now, when it comes to the grouping election for all of our tax people out there, this grouping election is not the same as the grouping election for the real estate professional status. This one is found under Regulation Section 1.469-4 and is typically used to group multiple business activities together. And as we know, when you have a rental property with an average stay of 7 days or less, you no longer have a rental activity for tax purposes, you have a business activity. So in order to group your short-term rental properties together as one activity, the IRS usually looks at 5 factors and puts the most weight on these 5 factors. Now, the good news is you don't have to meet all 5 criteria to pass, but the more you meet, the stronger your position, and the more likely it is that the IRS is not going to challenge your position. So let's go through each one by one, and we'll discuss how they apply to short-term rental investors. All right, so the first one is the similarity between the activities. Now, if you're operating multiple short-term rental properties, they are similar activities. Each short-term rental is pretty much the same, more or less, even though there might be some nuances. It's the same type of business activity. Now, the next one is the extent of common control. Now, if you have legal authority to make management decisions across all of your short-term rentals, perhaps you're the only owner or you're the lead partner if you do have partners, then you're going to be able to go ahead and check this box that you have common control. The next one is the extent of common ownership. Now, if you own all of your short-term rentals and you're the only owner, then you're going to go ahead and check this box. Now, if you're also having partners and all of the short-term rentals in question are all run by the same partnership group, for example, then you can also go ahead and typically check this box. Now, the next one is going to be geographic location. And if all your short-term rentals are in South Florida, for example, you're typically going to be able to check this box because all your short-term rentals are going to be considered to be in the same geographic location. However, if you have short-term rentals in South Florida and you also have short-term rentals in Houston, Texas, for example, you're typically not going to be able to check this box because they are in different geographic locations. Now, the last one is interdependencies between the businesses. Now, when it comes to short-term rentals, each short-term rental typically operates independent of each other, and you're not going to typically check this box. Now, again, the good news is you do not need to check each and every one of these boxes, But if you're a short-term rental investor, it's not uncommon to check the boxes of similarities between the businesses, extent of common ownership, and extent of common control. So for the most part, we're going to be able to check these 3 boxes in most cases. Now, when it comes to geographic location, if you do have all your short-term rentals concentrated in one market, for example, South Florida, then you're going to be able to go ahead and check that box as well. And if you're able to check 3 or 4 out of these boxes, then in most cases, you're going to be in pretty good shape to go ahead and make this grouping election. And again, I want to reiterate, the point of making this grouping election is to satisfy the material participation test. Instead of having to meet a material participation test across each and every property, you're able to meet one test across all your properties, which substantially eases the burden of this requirement. Now, before we leave here today and wrap up this video, I do have to point out some stipulations that you're going to want to be aware of with this grouping election. The first one is, once you group your short-term rentals together, it is hard, or challenging rather, to ungroup them because it typically requires IRS approval unless there's a significant change in your circumstances. So if you're going to go ahead and make a grouping election, make sure that you're certain that you want to group these short-term rentals together for the long term, which should be easy to do in most cases, but you want to carefully consider if that's the case for your specific situation. The next one is that you do have to file this election with your tax return, which typically involves filing a statement with your tax return detailing that you're making this grouping election and the activities that are involved with the election. If you're working with a tax professional, they can typically do this on your behalf, but it is just something that you want to be aware of. So to summarize this video today, if you do own multiple short-term rental activities and the average stay is 7 days or less, and you're looking to use the short-term rental loophole, if you do not make a grouping election, you have to meet a material participation test on each and every one of your rental properties, which can quickly become burdensome as you're going to have to spend a lot of time on your short-term rentals, and that could be challenging if you have a full-time job or you're running a business on a full-time basis. So by making the grouping election, you are able to satisfy one material participation test across all of your short-term rentals, substantially easing the burden. So if you do have questions about this, do drop us a comment. We will go ahead and answer as many questions as we can. And remember, if you did like this video, hit that like button and also hit the subscribe button and that bell icon so you don't miss out on future videos, which could just save you some money in taxes. We'll see you on the next one.